Okay, to go into a little bit more detail about diagnosing within a company. So this is not necessarily about how to rectify or to make changes, but just to diagnose. There will be in your industry a profit margin, a net profit margin, which you will be able to find or will be able to define by publicly available information and through your own research as to what your industry, unless you've got something very unique and different. If you're working in an industry where there's other players, which most people are, then there will be a sort of set point, if you like, in terms of a reasonably achievable net profit percentage, and that may be say 5%, 10%, 15, maybe even 20%. That number would be good to define and to understand whether your business is actually achieving that or not. And then that will open up a discussion around different areas of the company and how improvements can be made. So in a conventional accounting situation, you will start with your revenue, with your sales, you'll take off all your expenses, and what's left at the end of that is profit. Now, if you flip that around, you stick with your sales, but you take your profit off that, and what you're left with is expenses. So if you know, for example, that an exemplar business or an avatar business in your sector would make 15% net profit, then you can look at an aspirational revenue sales position for your company, take that percentage off, and or even put your actual sales in. Look at a 12-month period, sales in minus your 15% that you aspire to make, and what is left is your expenses. Now, does that constitute the expenses that you're seeing in your business right now? If it doesn't, then you may be making more or less profit. Now, more is not a problem, although your shareholders will want to know what your plans are to do with that. Otherwise, they'll be looking to take that as dividends. But profit is good. Profit is good because it builds resilience in the company. It builds short-term resilience. If you're looking to weather the storm in a situation, then net profit, the higher it is, it will be linked to cash flow, and to some extent it'll be an indicator for cash flow. So if you're a profitable business, the chances are you have more cash available, which means you can weather short-term events. You can face up to things like COVID and unforeseen situations where maybe you get put under pressure, your revenue line gets put under pressure, costs change and fluctuate, and things go differently to how you planned. Then you've got that short-term resilience. But in the longer term as well, profit allows you resilience because it allows you to invest that money back into projects, research and development, into training staff, into improving facilities, assets that you use to make them more valuable, to make the business stronger. And so that makes you more investable. It increases the value of the business, but it makes it more resilient and stronger in terms of being able to compete and actually make future profits as well. So profit is good. My starting point would be to understand what would be a desirable profit level, look at the costs in the business, and see whether or not that is actually being achieved. And if it's not, which in most cases it's not, most people don't do that sort of exercise where they reverse engineer it and look at the profit as in the first instance as what they're looking for the business to achieve. Then it opens up a whole discussion around what you can then do next, which is a whole other piece of work around productivity and around what resources you use and what's outsourced and what's within the company, and how you deal with cash and how you deal with automation and with technologies and how you make these improvements such that the business is more efficient. So there's a lot of work that it unpacks when you do a diagnostic, but I would certainly start with a very simple concept of sales, profit, aspirational profit, costs, and then break those costs down into things like cost of goods sold, into operating expenditures, and go through an income statement from top to bottom and look at how that compares to an avatar that you've created for the industry, and see where you measure up and where you don't measure up. It's become quite a confronting exercise, but at the end of the day, that's the starting point to then go in and make improvements for a better and more profitable, more resilient future for the company.